Well, the Federal Reserve is being flippant again. Hey everyone, meet Kevin here. I just listened to an interview that Bloomberg held with Federal Reserve President Barkin, and he gave his commentary on his thoughts after Jackson Hole. A lot of the interviews from before Jackson Hole I don't think are greatly useful right now because we got a J-Pow that was very enthusiastic about the time has come for rate cuts. But how many rate cuts? In fact, some have been speculating that, hey, the Fed will probably want to go 25 because when we went up in rates, we went 75, then 50, then 25. So we went up quickly at first and sort of slowed down and tapered. Now people think we should do that in reverse, where you slowly hit the gas on rate cuts and you go 25, 50, and so on like that. But you have JP Morgan suggesting, no, we're going to have two 50s and then a 25. So a lot of these enthusiasms, and I wanted to listen to what Barkin thinks because he's more of a hawk than Powell is. But he's going to be a loud voice at the FOMC. In fact, what we should do is we should do a quick check FOMC voting members. You could always Google that. Just type into Google FOMC voting members, and you can see which members have the loudest voices. For 2024, the first potentially 3 rate cuts, Barkin is on. So I think this insight from Barkin is quite useful. So Barkin starts out by saying that if the numbers we get are pretty good on inflation, but not really good, there is a risk that we plateau at a level of inflation above 2%. Now, I personally don't think there is a risk of plateauing above 2%. I actually think there's a greater risk of deflation, frankly, of us going way below 2%. But what's fascinating is you're getting this Barkin who says there's a large part of the economy that's standing by, waiting to start spending, both in the housing market and business fixed investment. So businesses spending on their businesses, basically investing in their business. And he says both of those are actually real risks to inflation because right now they're trying to push down shelter inflation, one of the lingering levels. But if we now lower rates while we haven't built more housing, is it possible we actually drive up housing costs and drive up shelter inflation again? And so Barkin, let me rephrase this. Powell, when we heard Powell, he's like, hey, the time has come for rates. And everybody's like, moon. But now you've got Barkin who's at the Fed, and he's got this more moderated pitch here, which in my opinion means if you average these two, you're probably only getting 25. But you're actually getting a Fed that's going to move more methodically and more slowly than Powell implied or suggested. See, his concern, Barkin's concern, is that inflation could reaccelerate. Of course, that's everyone's concern. But his thing is, how much change are we going to get from people when we start seeing rate cuts? In fact, they're already starting to see the mortgage industry pop off again. Not like it used to be, but they're talking to mortgage bankers and frankly, banks, mortgage brokers, mortgage bankers, whatever. And they're seeing more and more people apply for mortgages, not because they want to, but because they have to either move, downsize, upsize, or they have debt to reconsolidate. So this is why some of the mortgage companies, the LDIs, the more risky one, the Rocket Mortgage, the United Wholesale Mortgage Co. It's one of the reasons these companies have really come off some of their bottoms. And a lot of folks think they can kind of Nike swoosh up. But especially as rates continue to come down. But the problem with that is he doesn't see more housing being built, so he sees it as inflationary. So you've really got this sort of balanced voice to Powell over here that's like, I don't know. Now, also, he does talk labor. Now, he says that labor seems to be in this place right now where companies aren't really hiring, but they're not firing. And he's like, we're on this teeter-totter where we could kind of get blown over in either direction, and we'll see soon which way we go. And he says, hey, if inflation's still high and unemployment starts rising, we're going to have a hard time. But if inflation does come in meaningfully lower, then we can really fight the unemployment problem. So he was pressed, hey, what would a bad unemployment rate be? Keep in mind, we're at 4.3 right now. He said that it's hard to predict, but if we were at a 4.8 unemployment rate, that would be higher than neutral in our assessment. In other words, they would want to fight to bring that unemployment rate down, which is actually good. I was concerned that they were going to wait until the unemployment rate got to like 5.5% or something like that, because historically the unemployment rate has been there. So seeing them say, hey, 4.8 would be higher than we want, it's actually a good thing. He does also see deglobalization as a risk. I personally don't. I think re-globalization is what we'll see. But, I suppose you could mention risks without thinking that those actually have a very high level of risk. But anyway, then he does say that in discussions with businesses and, researchers or whatever, he thinks there are a lot of people making choices right now based on the direction of rate trajectory. And this could mean that he's waiting for that first meeting to see that first cut, to see how quickly people were going to move in reaction to that and spending again. In other words, let's get our September rate cut, 25 BP, and then what do retail sales look like in October and November for Black Friday? Are people going ham again? So I personally think that's going to lead the Fed to 25-25s, which I actually think is unfortunately somewhat bearish for the market going into the election, not just because we're going into the election. The first debate is September 10th. That'll be a big deal. Obviously, I'll be covering it. But also because, markets are right now pricing in that's interesting. This morning they were pricing in 1.32 rate cuts for the September 18th meeting. Now they're only pricing in 1.28, so it's gone down a little bit, probably because of this Barkin information and otherwise. But what you're also seeing is that yield curve. I think this is one to pay attention to. You're 11 basis points inverted right now, and we are at the highest level we have been absent the first 2 weeks of August. So remember when we had that craziness in the market? We're the highest level or closest level to uninverting. And usually that's when pain hits the markets. So I'm not highly enthusiastic. I know a lot of people are really excited about Nvidia earnings. I'm not. And I'll tell you why, because things are quite the opposite of what we've previously seen with Nvidia. So some differences that we talked about in the course member live stream this morning. Volatility is at the highest level going into Nvidia earnings that it has been in the last 4. We're, instead of talking about a Blackwell announcement and Blackwell being in production, we're going to be getting a Blackwell delay. We'll talk about that, commentary on that, although we could water that down. This is the first earnings report post-split, and skepticism about the stock market right now is a little on the higher side. So I'm a little nervous that this slower, more methodical Fed, at the same time as a nervous stock market, could lead to, unfortunately, the Fed overdoing it in the bearish direction. In other words, moving too slowly and pushing us into a recession. It's obviously too early to tell. Nobody knows. Obviously, if you think the risk rewards are great for investing in stocks right now, great, by all means. For me, cash, treasuries, and then there's a particular industry we talk a lot about in the course member live streams that I think will do well, soft landing or recession. So we'll see. But anyway, take a look at those courses linked down below over at meetkevin.com. And folks, I love you all. We'll see you in the next one. Goodbye and good luck. If you have any questions, email us at staff@meetkevin.com. Interesting little insight here from Barkin. And I guess it's also worth quickly noting, I think there was one other thing I wanted to touch on. Quick catalyst. Wednesday we'll get Nvidia earnings. Thursday we'll get GDP quarter over quarter. Thursday we'll also get retail, wholesale inventories and unemployment claims. And then we will get a University of Michigan on Friday. We have durable good numbers this morning, kind of mixed, like year over year negative, but month over month positive with the seasonal adjustment. So I'm a little confused by that. And extra detail, the historic unemployment rate is roughly 5.5%. So it looks like they would be uncomfortable even getting close to that, which is good. And I am grateful that they are focused on the jobs market, because I think that's really where they're going to screw up. Though they do seem to think that immigrants coming in are pushing, up this labor force participation, which kind of goes in hand with what T.S. Lombard says, that the reason it looks like the unemployment rate is going up is because participation is going up. More immigrants are willing to look for work, but they're not finding it as quickly. I don't know. I guess we'll see. Anyway, thanks for watching. See you in the next one. Goodbye and good luck. These
things that you told us here, I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.